From my research, I noticed that most people in their 20s in America had saved about $10,000 for retirement. That is not a large portfolio. So, how much dividend would you expect such a portfolio to give them if they invested it? You must probably be thinking that it would not be enough to pay for bills, supplement the income, or even fund a vacation. In this video, I will take you through different investment scenarios. Then we will explore how much dividend income a portfolio of $10,000 will give in each scenario. The knowledge gained from this exploration will help you on your financial journey. In addition, you will know how much money you would probably need for a financially independent life. I will highlight some of the mistakes investors make as beginners and how you can avoid them. You will also understand how you can exponentially increase your investment. We all need more money, don't we? Before I proceed further, please make sure you watch this video until the end. And do not skip any part so that you don't miss out the important information that could potentially change your life. Also, please give it a thumbs up. Don't forget to subscribe and turn on notifications. There are two ways you can invest in stocks that give dividends: an index and exchange-traded fund ETF, or buy individual dividend stocks. I will start with the most common. The most common index for beginners is the S&P 500. It will expose you to the 500 largest U.S. companies with a history of stability and profitability. That is why it is very popular. One strength of the index is that it is well balanced. It covers different sectors of the stock market from finance to technology, healthcare, production, etc. When you invest in this index, you can rest assuredly knowing that you have diversified your portfolio. Warren Buffett, one of the most successful investors in history, highly recommends the S&P 500. This is because the index has a good track record of healthy returns. But for our purposes, the yield from this index is a little low. If you purchase an ETF or index fund tracking the S&P 500, you get a dividend yield of less than 1.5%. You must agree with me that it's pretty low. This is because most of the largest holdings in the index are technology companies that pay little to no dividends. Let's do some calculations. If you have a portfolio of $10,000, the index tracking the S&P 500 will give you $150 each year. Monthly, that would be $12.50 in dividends. The Dow Jones Industrial Average is another common index. People affectionately call it the Dow. It is usually ranked second to the S&P 500. The Dow is made up of the 30 largest U.S. companies. Many analysts use the S&P 500 and the Dow to analyze the economy of the United States. The SPDR Dow Jones Industrial Average ETF Trust DIA is the best index that tracks the Dow. The dividend yield is just over 1.5%. There are other higher-yielding indices or ETF in the market. I suggest you focus on the one that will give you a higher income with less focus on capital appreciation. Most of these indices hold stocks of stable companies. Also, ensure you search around for the dividend history of the index. The Invesco S&P 500 Index ETF is one good example. It has high dividends and low volatility, with a dividend yield of 4%. You must agree that this is much higher than the S&P 500 and the Dow yield. One strength of this ETF is its focus on the companies paying the highest dividends, but its weakness is that it has lower growth over the long term. Let's do some calculations. First, if you invested in the Invesco S&P 500 Index ETF with a sum of $10,000, you would have an annual yield of around $400, or $33 each month. I discovered that older investors' emphasis is on high dividend funds. This is due to the higher stability they provide. These funds tend to perform better during bear markets and badly during bull markets. Retirees prioritize stability and regular income from such funds. I'd appreciate it if you could take a moment to hit the like button. Your support will enable me to continue producing such useful content. If you have already liked my video and subscribed to my channel, that's awesome. Thank you. Now, let's get back to the video. You can tweak your search for higher than average dividends by narrowing down your search to specific sectors or industries. Some funds focus on particular sectors or industries. For example, some industries could be energy, real estate, healthcare, etc. One notable feature about doing this is that you can get higher dividends on some sectors due to the nature of their business. Take the energy sector, for instance. This is a relatively low-price sector, but with higher dividend yields. The low price is due to the volatility of the sector, which is scary, but the volatility also accounts for the higher dividend yields. The factors influencing the volatility of this sector include economic fluctuations, renewable energy sources, and regulatory changes. As a result, the Vanguard Energy ETF has a dividend yield of over 3%. You can also focus on the real estate sector. However, it is a slightly risky sector, as most companies pay a significant part of their profits to shareholders as dividends. For example, the Vanguard Real Estate ETF has a dividend yield of above 3%. Let's do some calculating. If you invested $10,000 in Vanguard's Real Estate or Energy ETF, you'd have a dividend yield of $300 per year. In a month, that would be about $25 per month. As I mentioned, another way to invest in dividend stocks is by buying individual ones. If you are a beginner investor, experts recommend sticking to index funds or ETF, because you would then learn about market behavior, grow your portfolio, and still receive stable returns. As a beginner, you shouldn't be taking too many risks. If you want to take risks, you must research and focus on individual stocks. Remember, the riskier an investment, the higher the yields. One feature you should be looking for in individual stocks is the stock's dividend growth history. I will advise you to start with the list of dividend aristocrats. Dividend aristocrats always reveal their dividends for the past 25 consecutive years. AbbVie is an excellent example of a dividend aristocrat whose yield can rise above 4.5%. Let's do some calculating. If you were to invest $10,000 in AbbVie, you would receive $450 per year or $37 per month in dividends. Also, the stock can appreciate or depreciate. It depends on the market. Another smart move with individual stocks is to screen the prospective stock based on its fundamentals. For example, check out the stock's payout ratio. Is it reasonable? Something around 50 to 60% or less is acceptable. Also, consider the positive earnings along with other metrics. Real quick, if you guys are enjoying this video, which I put a lot of time and energy into, I would really appreciate it if you guys tap the like button and make sure you subscribe with notification on. And if we get 2,000 likes on this video, I'll drop a brand new video next week about the same topic. Now, let's get back to the video. Individual stocks represent good opportunities for yields. Unfortunately, investors often sell them off due to bad news or when there is an earnings miss. The stock market can even react to a change in management. Don't allow the emotions of the market to sway you. Savvy investors first assess the severity of the news before making an informed decision. But let me give you some wise advice. If you are still young, ignore dividends entirely. Investing in growth stocks can make a lot of money in the long term. As a young person, seek a growth stock rather than a dividend-paying investment with lower overall returns. Do you realize that a 2% difference in your annual rate of return can make a huge difference in your life? Imagine someone at the age of 25. If they invested $10,000 and earned an 8% rate of return, at the age of 65, they would have $217,000 in their portfolio. Now consider when the rate of return is 10%. They would have approximately $450,000 in their portfolio at age 65, or even double that amount at retirement. You need to know something about growth stocks. They can be more volatile. New investors might find it challenging to handle. The Vanguard Growth ETF, or VUG, is an excellent option. This ETF holds portfolios of large-cap growth stocks such as Apple, Amazon, and Home Depot, along with other stable names. The ETF is known to outperform the S&P 500 over the long term, but the dividend yield is just less than 0.5%. This is because most of the companies in the ETF pay little to no dividends. Instead, they reinvest the profits in the business, accelerating its rapid growth. Let's do the math. the low yield from VUG would give you $50 per year, or about $4 per month in dividends, if you invested $10,000 in it. But consider the growth of your investment. VUG is known to have a 5-year growth rate of 7 to 5%, even in bear markets. So search for growth funds like this. Don't be obsessed with dividend yields. It can make you choose the wrong investment. You are better off focusing on growth stocks and ignoring dividends entirely. This is particularly so when you are young. The income from dividends won't make much difference to you. Whether it is $50 per year or $400, it cannot pay the bills or give you a vacation. Instead, focus on growth stocks. You will have more money in the future when it's time to retire than on retirement. You could switch your portfolio from a growth stock to a dividend-yielding investment, if that is reasonable. Don't make the mistake of focusing on dividend yields early in your life. Now, if you want to watch more videos like this, then you need to watch this video right here. This video is one of the best on this channel. You can click on this video to watch further.